You are listening to an entertainment program put together by a company called Financial Ineptitude. Anything said on this show is not an endorsement or professional advice. Would you really want to tell a court of law you were suing us because you thought taking financial advice from two idiots on a podcast put out by Financial Ineptitude was a good idea? Really? Clown hat smiley face.
Well, hello and welcome, everyone. Get on inside the China shop. You've made it to another exciting episode. I'm Shopkeeper Dan. With me, as always, is Kyle, creator of financialineptitude.com. How you doing today, Kyle?
I'm doing good. Excited about today's guest.
Today's guest. Folks, sit back, strap in. We've got none other than the CEO of Centerfin, Kyrill Asatur. How you doing today, Kyrill?
I'm doing great, guys. Thanks for having me on.
Do you like your hype man?
Yeah, you guys are awesome.
Does he get you pumped? Tell us a little bit about yourself, Kyrill. It looks like you've had quite an interesting career.
Yeah, sure. Happy to. So I was actually born in the former Soviet Union and raised there, and we moved here when I was a kid, about 9 years old, settled in New York City, which is where I live today. I didn't know anything about finance whatsoever. My parents wanted me to be a doctor, and I went to pre-med originally in college. Around that time is this is kind of the late 90s. I discovered finance through the stock market, similar to kind of how I think lots of folks discovered the stock market over the last couple of years. In the late 90s, we had the first internet, what led to a bubble, but at the time it was just lots of really interesting new companies and kind of Web 1.0 as it's referred to now. And so got very interested in the stock market, decided that that's what I wanted to do for my career. So pivoted to finance as a major, graduated undergrad, and was lucky enough to get a job at Goldman Sachs out of undergrad, kind of snuck my way in the back door there through operations, and then made my way. It was a tough year to recruit. It was 2000 recruiting when the internet bubble kind of burst, and so but was lucky enough to get a seat. Made my way eventually into the prime brokerage business, which is largely the business associated with the hedge fund industry, basically running the services and managing the relationships of hedge fund clientele that Goldman Sachs had. I kind of noticed early on. I read a lot of the When Genius Failed books and Market Wizards books, and got kind of obsessed with the hedge fund industry. Also noticed that all the smartest people seem to be starting hedge funds or going to work at hedge funds. And so figured, why not align myself with the hedge fund industry? So Goldman had, and to this day still has, one of the best franchises in that business. And so, spent the next, 8 years working in that business at Goldman. Eventually, one of my clients, a distressed credit hedge fund founded by also ex-Goldman guys, hired me to come on in a kind of a business development, marketing, investor relations capacity. So spent the next 5 years there, was recruited into a handful of roles at other firms before I basically decided about, I guess almost 6 years ago at this point, to hang up my own shingle and work in an advisory capacity as a consultant advisor to the alternative investment management industry, which is, includes hedge funds and others. Mm-hmm. And then about 2 years ago, decided to start what is now Centerfin. So put a team together and started building right around COVID, believe it or not. And we went live in private beta at the beginning of this year, and off to the races.
All right, there's a lot to unpack in there. So let's go all the way back to the beginning. You said you initially went to school to be a doctor, and then you pivoted to finance. How pissed was your mom at that decision?
Oh boy.
Because I've noticed that people who put their kids through med school really want their kids to be doctors.
Yeah. So growing up as a relatively poor Jewish immigrant, there's very few professions that kind of former Soviet Union mothers and fathers want their sons to and daughters to pursue. Largely doctors and engineers. That's kind of the two professions that they knew. And so yes, it was their dream for me to be a doctor. I figured out in the first semester of my pre-med kind of track, I was at NYU originally, that I hated it. and I didn't want to do it. And at the same time, as I mentioned, I was discovering kind of the world of finance and Wall Street through the stock market, and always had a kind of a knack for numbers. So decided that I wanted to do that. I actually didn't tell my parents that I canceled all of my second semester electives. I canceled all of them, and I took second semester pre-med classes, and I took electives to try and figure out, are there courses that I could take to help me get closer to finance. So yeah, they were pretty pissed once I eventually told them, but they were supportive nonetheless.
Why do you think the doctor is like the dream?
So I can't speak to other families, but I think for immigrant families in particular, especially, kind of Jewish families coming from the former Soviet Union, there were not a lot of professions that were available to them in the former Soviet Union. And the two kind of more prestigious professions were, being a doctor or being an engineer. And so that's kind of all they knew, really. So that was, that's what they always thought.
That's kind of what I thought. That's really interesting, though. I mean, nobody wants their kid to perform, stand-up comedy, but a good job at a good bank, you think they'd be all for that too.
Yeah, they eventually came around to it. It took some convincing.
All right, you said you snuck in the back door at Goldman Sachs. Can you elaborate a little more on that?
Yeah, it's a good question. So when I decided to pivot to finance, I ended up making the decision to switch schools. I went from undergrad at NYU to another school that was local to me, Hofstra University on Long Island, which is where my parents were living at the time. And even though I was graduating with a very good GPA and great coursework and all of that stuff, it was not a school that Wall Street actively recruited from. And so I banged my head against the wall. I sent my resumes, and again, this was 2000, so this is when the internet bubble burst. Right. And so hiring, froze at the banks, and you basically needed to get an offer the year before. So I graduated in 2001. So in 2000, it was kind of when I was applying for jobs. And so I sent my resume to pretty much every division of every Wall Street bank at the time. And I literally got no answers. I think I got like one rejection postcard from Morgan Stanley or something like that. Oof. And it was very discouraging. And so I was set up for kind of an informal meeting with a bond trader at Salomon Brothers at the time. And I remember meeting with this guy, and he was, relatively young, maybe in his late 20s, early 30s. And he was running one of their mortgage desks, and, he seemed like he was doing great. And so he had one piece of advice for me. He said, listen, he's like, I had, kind of a similar background to you. I didn't come from maybe the right school to get into some of these, really coveted roles on Wall Street. But I did get my way in the door in kind of operations at Salomon and work my way through the system until, now I'm running this whole desk and, doing great. And he said, my advice to you would be find the best seat you can, in the operations division, the non-front office, as they call it, part of a bank. And then try to work your way through the system. So that's exactly what I did. I focused on Goldman. I got, an interview in their global operations program, and I was one of two people hired from my school that year.
When you say the operations side, what exactly does that mean?
So it's referred to often as the back office, right? So it's kind of handling all of the back end of transactions,
like bookkeeping kind of stuff.
More like settlement, and there's some bookkeeping elements to it, but more like settlement of transactions. So for a simple example, if a equity sales trader at Goldman does a trade with a hedge fund, to buy some block of stock, that trade then needs to go through the confirmation process and then get settled. And there's a bunch of people. Well, it hopefully is more automated today, but 20 years ago there was a bunch of people that were involved in doing that. And so that's what, and it was largely referred to, it's basically kind of all the non-front office functions of a bank, of an investment bank. So across the street, that function area was called the back office, which kind of always had like a somewhat of a negative connotation to it. Goldman was always a little bit more thoughtful about that, and they always referred to it as operations. Later in my career, when I was already kind of on the buy side, they actually started to refer to it as the Federation inside of Goldman. So it was like, it was just given a lot more importance at the bank in terms of the functions and the leadership there.
It's funny, but some things that get looked down upon, but they're absolutely integral to the operations.
Huge, yeah.
Right. So what classes did you actually take to kind of set you up for this? That's one thing I've always been curious in, is like what kind of education can you actively pursue rather than just trying to do it all and learn the hard way?
So I took all of the finance classes, finance 101 to whatever number it was. I learned, all the basics of time value of money and kind of modeling out cash flows and macroeconomics, microeconomics. But frankly, what I really, the way I really learned was by, having, as I mentioned, I discovered the stock market at college. Mm-hmm. I borrowed some money from my dad. I opened up an E-Trade account, which at the time is probably the equivalent of a Robinhood today. It was new, it was online, it was cheap, and you can execute, trades fast. And I learned that way. I learned by, learning about companies, learning how things trade. Lots of really bad lessons. I mean, good lessons in experienced in bad ways, right? Where, when the market was going all in one direction, everything was great. When the market fell apart, lost a lot of money, learned some lessons along the way. So it was, I think those were important learnings for me alongside the college work, but frankly, maybe more important. And then reading lots of books, as I mentioned, even in college, I think before Goldman, I read kind of any book I can get my hands on that talked about the markets, finance, some of the stories about collapsed hedge funds like long-term capital management. There's a, famous book, I don't know if you guys have read, called When Genius Failed. That was a really interesting book for me to read. And then there was the
When Genius Fails?
When Genius Failed. Yeah. It's about the collapse of long-term capital management in the late 90s.
Interesting.
There's a bunch of Market Wizards books, which profiled all of the kind of old school hedge fund managers. I read all of those at the time as well. And you learn a lot from that as well.
What was your favorite then? Which book do you think taught you the most? I think all the Market Wizards books were really good because you just get to learn from these very successful investors, and you get to learn, they basically kind of explain their perspective and how they go about things and how they look at the world, how they, try to obviously make money, which is what hedge funds are designed to do. Mm-hmm. And it was just, I've always really enjoyed learning from people, successful people. And this was just a way to do it, that was just available to anybody that wanted to read those books. Mm-hmm. As far as hedge funds go, it seems like they have kind of a spotty track record at best. It seems like a lot of them don't really, they'll do well for a while and then they'll just absolutely implode. Why do you think that some of them seem to struggle so much?
Yeah, it's a great question, and I totally agree with your perspective, and I think that has become a very common perspective out there, and it's rightfully, kind of a reputation rightfully deserved, I think. And I think it's partially due to a couple of factors. So the hedge fund industry started in I think it was in the 60s or 70s. It was originally a very small cottage industry where it was largely kind of macroeconomic strategies. So if you think about, kind of the old school hedge fund managers like Louis Bacon, who ran More Capital for a long time, a lot of those hedge funds of that era were kind of macroeconomic hedge funds. And by macroeconomic or global macro, as they're referred to, it means that they're largely looking at the world at a very high level, top down. And so they're trying to see, what's happening, predict certain big trends, and then get ahead of them by positioning their fund to take advantage of those trends. And so macro was a very, very common, very profitable strategy. Paul Tudor Jones is another great example of one of the greats of macro investing. Stanley Druckenmiller of Duquesne, probably top five also of global macro investing. And so that time period in the 70s, 80s, 90s was very conducive to that type of strategy because there was just a lot of stuff going on globally. We were kind of in the first process of globalization. So lots of, currencies trading versus each other were changing their relation to each other pretty massively based on what was going on from a globalization perspective. Lots of opportunities to trade interest rates globally. There was just a lot of stuff to do in global macro. And then hedge funds kind of earned their stripes, I would say, in the internet bubble because a lot of them were positioned to actually weather that storm relatively well.
Can you explain what you mean by the dilution?
Yeah, sorry. So the more capital that flows into the industry, effectively, the worse the overall prospective returns get. It's just a matter of, kind of simple math. If there's, an opportunity to extract value out of the market that is limited, and you have 10 participants trying to extract that value for their funds and for their clients, investors, and all of a sudden you grow to 100 funds trying to do the same thing, well, the probability that, all of them are going to be able to extract that value is much lower. And also the average, extraction of value that each fund is going to get is going to be lower.
Okay. So you get 100 funds instead of 10. Now maybe only 10 are going to make money and the other rest are going to be clawing to break even or taking losses.
Yeah. Or if the profits before were substantial, it might average out to be something that's, pretty pedestrian.
Oh, that's interesting. It's an interesting way to look at it. So when you walked away from the hedge funds, what was your take? How did you feel about them when you left?
So I got a little bit, as I mentioned before, kind of post global financial crisis is when I actually joined my first hedge fund, which was a client of mine at Goldman. And at the time, the industry sentiment was very bearish. People, again, hedge funds lost money in 2008. They weren't really supposed to lose money. Investors were saying that's the death of hedge funds. But my personal view, having sat inside Goldman and watched some of the flows and talking to a lot of institutional investors was that we were just setting up for the next round of institutional adoption via the pension community. And the pensions had gone into the financial crisis very underallocated hedge funds, which are really, in most of those portfolios, they're referred to or used as diversifiers. So they're kind of supposed to be absolute return focused, less correlated to overall risk assets. And the pension community was grossly underallocated to hedge funds. And so I kind of saw that they were going to be the next wave of growth for hedge funds. But, that brought even more capital to the industry. So returns became even more muted. And so at some point, I just kind of felt like the industry was, consolidating / going into some sort of secular decline. And I wanted to take a step back and take myself out of it. Still kind of have my toe in the water and participate and keep in touch with all of my relationships. But that was kind of what led me to do that in 2016.
Why would they want to be invested in hedge funds? That was one of the things that surprised me with the whole meme stock mania was the hedge fund managers saying that retail's hurting the pensions and hurting school teachers. Why is a school teacher investing with a hedge fund?
It's a good question. So there was an article about this in the Wall Street Journal actually this morning about pension funds kind of taking on more risk in order to generate their returns that they need to meet their obligations. So going into the financial crisis, a lot of pension funds were not actively allocating to what's broadly categorized as alternative investment strategies. And so those are strategies that are, largely something slightly different than just, kind of plain vanilla stocks and bonds via either ETFs or mutual funds. It doesn't really matter, but those are kind of the asset classes largely that that pension funds were allocated to. Hedge funds, venture capital, private equity are all in kind of broad bucket alternative investment strategies. And the idea there is that, the managers of those funds, hedge funds, private equity firms, venture capital firms are using a strategy that is not, that is slightly different, that takes a different take on, generally the public market. So hedge funds were, by the pension community, considered a diversifier strategy. And so because hedge funds were not tied to be just long stocks, they can be long short, they can be short only, they can be in various different sectors. They were, taken collectively, a portfolio of hedge funds should actually increase the quality of the portfolio return over a long period of time. And that's why, and
that makes sense.
Yeah. And so the consultants kind of drove pension funds into the hedge funds, in my opinion, at the wrong time. We were, kind of post financial crisis, we were living in this, very easy monetary environment that the Federal Reserve created as a response to the financial crisis. And, what that meant, this is obviously with the benefit of hindsight, but some of this was already obvious. But what that meant was that it was just going to be very difficult to generate returns on an active basis. Basically lots of money into the system, floated all boats, and it kind of, reached a crescendo in 2020 with COVID.
Speaking of which, now that the Fed is finally starting to unwind that balance sheet, like what do you see as the future of the market being?
So it's super interesting. It's a internal topic of conversation for my team. It's something I talk to. I'm still very close with a lot of the hedge fund community. I talk to folk all the time about this. We potentially have entered a new kind of regime. In 2022, late 2021. Which is going to be very, very different than the prior decade plus, where, the Federal Reserve and central banks globally, they generally, let's speak to the Federal Reserve. They have two mandates, right? They have price stability, which means that inflation / deflation is somewhat controlled, and 2% is some arbitrary number that they use that they feel like is a good number for inflation. And then unemployment, right? And so unemployment is very, very low, as I'm sure you guys are aware. But inflation all of a sudden got out of control in kind of 2021, now into 2022. It's not really showing signs of abating. And so the Federal Reserve has no choice but to fight inflation, right? What that means is tightening financial conditions, raising interest rates, and that's really bad for stocks and it's really bad for bonds. And so it's a really tough environment. I mean, the toughest job in the world is at the hands of the Federal Reserve. The second toughest job is, anybody who's professionally managing money in this environment it's very difficult.
Right. It's even tougher for Powell now that he can't trade stocks anymore.
Oh yeah. It's a fair point, because I have this conversation, with my team and with others in the industry where, the Federal Reserve is made up of, fairly well-to-do people that own lots of stocks, and what their policy response has been, and looks like it's going to continue to be, at least for the foreseeable future, is really bad for stocks. And we've seen a 20% correction, but that's actually not that painful. It could potentially get a lot worse.
Where do you think the bottom's going to be?
I couldn't tell you, and I think anybody who tells you,
Okay, let me rephrase that. What would you need to see to call a bottom, to say that the bottom is in? I'll answer it in a little bit of a different way. If tomorrow Jay Powell came out and said, you know what, guys, we actually think this inflation thing is fine and it'll take care of itself, and we're just going to go back to what we were doing in the prior, decade, then everything's going to rally, right? Yeah.
It's just not likely that that's going to happen. So what we're paying attention to, and what we're talking to folks about, and smarter than us, is we are really focused on what's happening with the data that's coming out as it relates to inflation and the economy, because now it's a balancing act, right? Because the economy is already slowing. We're seeing that in the data. The market usually is a leading indicator, right? So the market started to sell off, really in late 2021. Some parts of the market start to sell off in early 2021. And so it's a leading indicator. So it's been showing us that there's a tough period of time ahead. And at first it's been focused on inflation. To date, it's been focused on inflation. There's some evidence just over the last couple of weeks here that the market is now starting to focus on growth or lack thereof, or slowing growth as its focus. And what that just means is that there's going to be rotation within the market, right? So we've seen lots of rotation from, growth stocks to value stocks, energy being the biggest one. And now we saw, just over the last couple of weeks, saw another rotation. And so we might just see some of this choppiness until we have more clarity around, what does the inflation picture look like? What does the growth or recession picture look like? And, some more clarity around what the Fed is actually going to do. There are lots of folks out there who think that the Fed and global central banks are just going to have to continue to hike. They have no choice, which would mean that, stocks have a long way to go down. And then there's some folks that think that the Fed is going to blink and they're just going to, stop tightening. And that will be a relief for risk assets, broadly speaking. But you have to pay attention. It's not going to be the same playbook as the last decade plus.
Do you think the midterm elections will have any effect on that Fed policy?
Yeah, I mean, look, the Fed is not supposed to be a political organization.
Not supposed to be.
Not supposed to be. Lots of other government organizations are not supposed to be political, but they are. Yes, I mean, midterms are important, and and we'll see. I mean, listen, the crazy thing, at least for me, is you're seeing some of these responses in Europe and in some states in the U.S. like California, where in order to help people deal with inflation, they're promoting stimulus programs, right? They're promoting checks to help pay for the rising cost of food and gas. And the problem with that is that it's well intentioned, but it's also what got us here. And so I think that, we have this, it's a really precarious situation because we're at a point in time where, what really pushed, at least in our opinion, what really pushed inflation over the line and made it a real problem was not the monetary policy response of the Federal Reserve to to COVID. That was part of it. But really, I think what pushed it over the line was the fiscal stimulus, right? So, stimmy checks, as they're referred to in the press, right? Like,
oh, really?
Yeah. I mean, that's like helicopter money, right? That's just government printing money and putting in your bank account. And that helps people, be able to, buy things that they previously weren't able to buy. And so some of it feeds into speculation, some of it feeds into prices of goods and services. And so responding to inflation by doing the same thing is a little crazy, but that seems to be where at least some governments are talking about and doing.
So you don't think the supply chain is the main driver?
It's all part of it. It's all related, right? The supply chain issues, they're actually abating, at least as far as we can tell. But the supply chain issues were also effectively a unintended consequence of shutting down the global economy for COVID and then restarting it again, right? Like it's such a complex system that you can't just shut everything down and restart it and not expect there to be hiccups along the way. And I'll tell you, on the East Coast here, I was at the beach over the weekend, and there's still, in the distance, there are, a big long line of ships that are still standing there waiting to offload their goods. So while the data is showing that it's abating, it's not gone, and it's not going to be gone, anytime soon. But it's not the main factor that's driving inflation today. It's actually, inflation seems to be transitioning from goods inflation to services inflation. And but you have to monitor it and see how it goes.
Super interesting. Thanks for your take on some of that stuff. Love hearing people who actually studied stuff rather than Dan and I just postulating.
Hey, I took some economics courses.
You did more than I did. Why don't you tell us? Let's start talking about then Centerfin, because it looks like your experiences from your 20 years in the financial services kind of helped push you to starting this. I'm kind of curious, what was the reason why? Yeah,
it was. How they say, necessity is the mother of all invention. I think it was a little bit of that for us. My whole career, I've had friends and family come to me asking for advice, what to do with their 401k, their retirement assets, their taxable assets. And I frankly just never had a good answer for them historically because, frankly, most options that are available to individuals are not great. They're poor quality investment options. They're way overpriced. And I just never had a good response. My best response would be kind of what, a lot of people have adopted, which is, just buy some low fee ETFs from Vanguard or something similar and just don't touch it. But, frankly speaking, going back to my point about kind of regime change and whether or not we're in a different environment than we have been over the last decade or so, that might not necessarily work over the next decade. And so one of the, so take another step back. So basically, Centerfin was originally conceived as the idea to bring the institutional quality investment approach that I learned from, lots of the institutional allocators that I covered that invested in hedge funds and other alternative investment strategies, and try to replicate that approach and bring it to individuals. That was kind of the very high level idea. That doesn't just mean, doing exactly what those firms do, but bringing that approach where, you start with kind of a broad top-down asset allocation thought process that informs, what assets you want to be invested in and what assets you don't want to be invested in. And within those asset classes, maybe potentially in the equities space, sectors that you might want to avoid or overweight to. And then potentially partnering with alternative investment firms in various categories to increase the quality of the overall return. All right. So that diversification purpose that I had referred to originally. And so, so that's kind of, that's what we're doing with Centerfin. And, and frankly, it's not something that exists in the market. There's lots of, you'll see lots of stuff like, there's a startup that just focuses on art as an investment. Art might be a great investment. Art is also, potentially on the very speculative end of like this, blow off top that we saw in risk assets in the last, 2 years or so. So I would say, that's not something we would recommend. But would we recommend, distressed debt as an area? Yes, that's something that we think is super interesting. Would we recommend global macro? We think that's super interesting for the first time, since, pre-financial crisis. So those are kind of areas that we focus on that we think are interesting. They're not going to always be interesting, but, given our experience and our relationships, this is stuff that we can actually, I think, prudently diligence and ascertain and design in client portfolios and do it with using technology with scale. So that's the gist of Centerfin. Obviously, it's a lot more complicated than that, but that's it at a high level.
I was reading through some of the stuff on your website, and under the article where you talked about why you started the Centerfin, there was a blurb in here about market index funds and ETFs dominating market inflows. And because they're growing their market share, there's a disparity in company valuations, a lack of corporate governance setting the stage for the next financial calamity. Can you explain what you mean by that?
Yeah. I appreciate you reading the stuff. It's, we try to put everything we do on paper and provide clarity and transparency for our clients and for, prospective clients. And we're not going to be right 100% of the time, but at least we're going to have a track record of, our point of view at any given point in time. As it relates to passive funds, right. I think that the amount of dollars that have flown into passive funds managed by Vanguard and BlackRock, amongst others, has been so huge that at some point in 2018 or 2019, they overtook the majority of the market, at least for stocks. And so what I mean by that is that, more than half of all the stocks were owned by index funds.
Oh, okay. Yeah.
And so that's pretty, and that's huge. I mean, that's like, I think that ratio is up, I forget the numbers, but it's a big move, right? Because A, it's been working. B, it's been a popular strategy for individuals that don't want to pay high fees, and and if it's working, why not do it? But the potential unintended consequence of that is that these index funds, there's nobody sitting there making a decision on whether or not Coke and let's just use a simple example, but there's Coke and Pepsi. Should we invest in Coke or Pepsi? Is one potentially, better operationally, has better margins, potentially more valuable? Nobody's making that decision, right? Coke and Pepsi have a weighting in the S&P 500. Coke and Pepsi have a weighting in a consumer staples ETF. And every dollar that goes into an S&P 500 ETF or a consumer staples ETF gets on a pro rata basis to that weighting of Coke and Pepsi, gets plowed into Coke and Pepsi. And so, so all these dollars go into these ETFs, into these passive index ETFs. They get, without any kind of thought and, any consideration to the potential relative valuation discrepancies between different companies, they get plowed into these companies' stocks at the ratio that they are given in that index. And so, so basically it's kind of, to go back to, something I think I mentioned before, but kind of lots of liquidity kind of flooding the market, right? It just, so if you just look at it in the stock space, you're basically just flooding stocks with capital without any kind of discrimination between potential valuations. And so, there might be a company that's, better operated and should deserve a higher valuation than another company, but they're just getting capital at the same rate that their weight is in the index. And so that's what I mean by there's no real discrepancy in valuations. Nobody's sitting there and doing the work. I mean, there are some active managers that are trying to do that, but because the passive index funds now own more than half the market, that's kind of what's driving prices more so than, somebody saying, hey, I want to be short Coke versus Pepsi or whatnot. And so that's part of the reason, that's part of the problem in our view, is that it's kind of, distorted a little bit, I guess is the word, valuations, because, you're just kind of giving money to all companies at whatever their index weight is, regardless of the valuation that might be right or wrong. And corporate governance is a big problem, right? Because, and Carl Icahn is probably the loudest voice out there talking about this. He's a colorful character, and I know. You have to admire the guy for he's been at it for a long time, still at it. And but he's talked about this, right? He's talked about the fact that BlackRock does not hold these corporations to account, right? Whereas Carl Icahn's whole thing is he's an activist investor, so he sees companies, he sees stocks as companies. Companies are run by people. Those people need to be held to account, right? They're fiduciaries. They need to do the right thing for the shareholders, for the company, the shareholders, customers, but, from his perspective, for the shareholders. And BlackRock doesn't do that, right? BlackRock will just, they might be the biggest owner of a certain company, but it's not like they're going in there and saying, hey, you guys are doing something wrong that's potentially a breach of your fiduciary duty, right? They're just kind of doing whatever the proxy, voting agencies tell them to do.
Really? So when they vote their shares, they're just voting whatever the board recommends?
It's whatever the proxy vote. There's like a handful of proxy voting kind of companies out there that recommend whatever the vote is, the shareholder vote is. And typically these index funds just do whatever they recommend. And that's not always the right thing.
Wow. No, that's super interesting. I didn't even think about that. So you've got half of the assets owned by an entity that basically doesn't take the corporate governance or the duties of a shareholder seriously.
Yeah, and that's been, they're trying to address that, but I think, thus far it's been more, marketing than actual substance.
So how do you think this leads to the next financial calamity then?
Well, I mean, if you just kind of think things through to the next the next iteration of that, right? You have a market where there's been no real discrepancy in valuation between companies because it's largely driven by passive index flows. You don't hold those companies to account, right? You're not holding them responsible for kind of doing the right thing. So there's going to be companies that are, making the wrong decisions, and nobody's really paying attention. And then when things reverse, and like we're seeing right now, and we haven't really seen it actually in fund flows and kind of retail fund flows, we've seen still a pretty healthy record of passive inflows into stocks this year. We've seen a pullback in institutional stock flows, pretty significant, pretty dramatic pullback. But when you do see that, and you've seen stocks go down, but let me tell you, if we see retail fund flows reverse, and they'll reverse if there's enough pain, that's gonna lead us in the other direction, right? That's gonna be indiscriminate selling by the passive index funds, because that's all their job is. They're just passing along, either they're buying the stock or they're selling the stock.
So as retail starts closing out their ETF holdings, then that money gets pulled out in the pro rata basis on all the holdings of the ETF. Exactly.
It just goes the other way. And so, if we do have, and it's not just retail, I mean, it's broadly speaking, right? Like, I mean, it's broadly speaking, if there's a pullback from the passive index approach, which we think could happen because we think that, we are in a different market regime than we have been for the last decade plus, then, it could be very painful. And like I said, 20% down on the S&P that's not painful. It could get a lot more painful.
Oof. Man, that's a lot that we've covered in a short period of time.
All right. Well, you want to move on and start talking about some crypto?
Go ahead, Dan, if you got some questions lined up.
Well, not any specific questions, but just my general. Do you think crypto has inherent value like a company does, like shares in a company?
It's a great question. So broadly speaking, I think crypto is not any different than any other speculative asset class. And so, kind of going into this very recent period of time where you had a lot of liquidity driven by both the monetary and fiscal governments into the system, effectively driving up asset prices. It typically, the more dollars you have in the system, the higher on the speculative scale that those dollars go. They kind of flow into higher speculative assets. Crypto is probably on the highest end of speculative assets, maybe similar to investing in art, as I alluded to before. Within crypto, though, I kind of, and this is my personal opinion, I view Bitcoin as something separate from kind of the rest of the crypto market, where I can see a value for Bitcoin that's not ascribed to it the same way as to a company, but maybe more akin to a currency. And that's due to the fact that it's a fully decentralized, non-sovereign risk asset. And I think there's a value there, right? There's, if you're in crypto, the term, not your keys, not your coins, right? You can, if you hold your coins on, in cold storage in your own wallet, unless somebody physically takes them from you, you can't lose them. Now, so that's kind of the use case in my view on Bitcoin. And I developed this view back in 2017 when I was talking to a business person from Venezuela. And and this is a guy, he was like a grandfather and he was a successful businessman. And he said to me, thank God for Bitcoin, because otherwise everything I've worked for my whole life would be gone, because Venezuela, as I'm sure you're aware, kind of devalued its currency, which meant, people lost their wealth basically. And he was able to convert some of his Venezuelan currency to Bitcoin and save some of that value. And so I think so that's where I think Bitcoin's value comes in. Mm-hmm. I think everything else, and I think it's still early and it's not even clear that Bitcoin, is if you were to refer to it as a global, non-sovereign reserve currency, it's not even clear that Bitcoin is it. It has the longest track record. It's never been hacked. And, they've tried to shut it down in China like 5 times. It's still around. From a fundamental perspective, it's still doing well. Price-wise, it moves around, obviously, in a drawdown right now. But that's how I think about Bitcoin. I think Ethereum and some of the other kind of layer 1 networks are, also interesting, but they think very early. The use cases need to be proven out. And so do I think Dogecoin is worth anything? No, I think the fact that, Dogecoin still has a $7 billion market cap is a problem, and it'll eventually go away. But I think there's something to Bitcoin. And so I've been personally recommending to my friends and family since 2017 to put a small percentage, 1 to 3% of their net worth into just Bitcoin, maybe, a mix of Bitcoin and Ethereum, with Bitcoin being kind of the biggest piece of it. That's my personal recommendation to to people I love and care about. I think, for clients, we've taken a similar but different approach and not using direct coin exposure, but things that have been developed in the market today that are good proxies for kind of the crypto market in general. But we still view it as a very speculative space.
No, that's a very nuanced take. So you're more in line with viewing crypto as an actual currency, not necessarily like a commodity, like the Senate bill is trying to make it happen.
So yes, I think Bitcoin itself, and Gary Gensler was on CNBC this morning talking about it. He said, he thinks rightfully so, Bitcoin has been kind of classified as a currency or a commodity, which is, currencies and commodities are kind of similar from that perspective. And I think that's probably appropriate. And I think that, the secret to Bitcoin is, again, it's the fact that there is value in being able to store, value, yourself without an intermediary, right? And, people say, well, that's great, but if you can't use it to buy stuff, then who cares? But there's still value there. And I think that what we saw recently with the protests in Canada, if you were following the truckers protesting Canada's COVID, rules, the government there issued the banks an order to freeze some of those protesters' bank accounts. And I think that was like a living, breathing use case for Bitcoin, right? Because it doesn't matter if you live in a democratic country, you find yourself, maybe in a situation where, you're doing something that's opposed to the government, they can confiscate your assets. And so, you're seeing it right now, maybe more fairly with, Russian oligarchs, right? And the sanctions that were put on them. So, but that's governments confiscating your assets because they're held by an intermediary, and Bitcoin solves that problem.
Well said. Well explained. Thank you.
I like how you just managed to segue in right into Russia, right at the tail end of the episode. It's something that I've been holding back and really wanted to ask you. We got permission from you beforehand, but yeah, you said before we started talking that you grew up in Ukraine. I was wondering if you had any insights on what's actually going on.
Thank you
over
for
there
asking,
right now.
and I don't mind talking about it. I was born in what is now the eastern part of Ukraine, in the second largest city in Ukraine, called Kharkiv. Kharkiv right now is, my understanding, 60 to 70% destroyed. It was not only the second largest city, it was also the educational capital of what was then the former Soviet Union, and now Ukraine. It has the largest amount per capita universities, I think, in Europe. And so what's happening there is, obviously, it's very personal for me because that's where my family's from. And luckily, most of my family followed us to the United States in the late 80s, early 90s. We do have some friends there. They've had to flee their homes and move to other parts of the country in the West that are safer. It's tragic. And I think that when people used to ask me about, being Ukrainian, and I should mention that part of Ukraine where I grew up, it's Russian speaking because it's so close. It's so close to the Russian border, what is now the Russian border, that, I grew up speaking Russian. I speak Russian today. I don't speak Ukrainian, but I identify as Ukrainian. And when you would ask me or anybody else from that part of the world about whether or not, is there any difference between, having Ukraine have its own sovereign government or it being part of Russia or the former Soviet Union, I think most people would cynically tell you, what difference does it make? Because you have one corrupt state, you have another corrupt state, and so you're just living in one or the other, and who cares? But the truth is that I think Zelensky, who came into power recently, the current prime minister, president, he he did come in with this, different message of, freedom and economic freedom and, modernization of their economy and, more of an inclusion into the European Union, which I think he's, now desperately trying to achieve. And I think that's resonated with people. And I think that, people want that now. And instead of that, they got, Russia invading them, trying to take them and become part of the, just become what it was back in the Soviet Union. And so,
if we're being honest, I don't think anybody, even if like I was a huge Canadian fan and wanted Canada to own my town, if I identified as Canadian, I still wouldn't want them coming into my home and blowing it up.
No,
in order to make that happen.
You're absolutely right. There are people in that part of the country that want Russia to want to be part of Russia, and they kind of still identify with the former Soviet Union and kind of everything that it represented, which is crazy to me. But yes, I mean, Russia is not. They're not. There was just a report today. They just bombed like a mall with like 1,000 people. 1,000 innocent people. They're committing war crimes. Every day, and we're kind of sitting here, watching it from a distance. But it's tragic what's going on.
Yeah.
God. Thank you so much for your insights. Really do appreciate that. I know it probably can't be very easy talking about something like that, even though you've been removed from it for a while.
Definitely not a great situation. Just you got to hope for some sort of it doesn't seem likely, but some sort of resolution one way or another. Sooner rather than later.
Yeah.
I will say, I think Zelensky's earned a lot of fans over the last year.
And I think he's done a great job. He did. I should point out, like, he wasn't a saint going into this. Like, he has some affiliations with a Russian oligarch with some, definitely some, there's some black marks there, but he has done a good job since the crisis. Like the one childhood friend that I personally stay in touch with who lives in Kiev that I have chatted with did not vote for Zelensky, was not into him at all, but has become a huge supporter since the war started because, he just feels like he's done such a good job since the conflict started.
Wow. That's refreshing to hear. I'm not used to somebody being like, I didn't vote for him, but once they got in office and started doing this stuff, I can admit it was great.
Right. Most people don't want to ever change their minds.
Changing my mind. Ugh.
But Dan, how are we doing on time?
We got about 5 more minutes if you want to stretch it. Otherwise, we can wrap it up. We've covered a lot of topics.
I think we should let Kyrill talk about where people can find Centerfin if they want to learn more, where they can follow him on social media.
Yeah, I appreciate that, guys. Thank you so much for doing this, by the way, and congrats on the podcast. It's I know it's a lot of work, and appreciate you guys having me on. So again, Centerfin is really what we think is an alternative approach to kind of what's traditionally available for individuals. We think it's ever more so important today in potentially a very different regime than we've been living in for the recent past. And so we're happy to talk to people about that and why we think so and what we're doing about it. We are, you can look us up at centerfin.co. I'm Kyrill, Kyrill at centerfin.co. I'm also on, we have all the social media presences, but I'm also on Twitter personally, Wall Street Hobbs, Wall STHOBBES, and happy to engage with people and have a conversation.
Well, Hobbes as in the philosopher, or Hobbes as in the
as in the philosopher? Yeah, I got. Although the other Hobbes is also a philosopher, I think. So, yeah,
that's my favorite. That's my cat's named after.
Wall Street
underscore Hobbes.
Wall ST Hobbs.
Well, Hobbes, I'm trying to add you, so there you are.
Awesome.
Okay.
I'll follow you back.
I'm following you now. We'll make sure that we have links for everything in the episode description. So if you missed, if you're not quick enough typing that out, we'll make sure that make it easy for you guys to click on those links. Also, we'll have links for the books that you mentioned too. I definitely want to check out some of those Market Wizards books.
Got my eye.
Yeah, that one sounds
and
super
I will
interesting.
chime in with another book that if you're interested in like personal investing and trading, so there's a book called Reminiscences of a Stock Operator. Oh yeah,
I just wrote it.
Isn't it amazing?
Such a good
Great.
book.
Everybody needs to read it. It's amazing.
How did you put him up to that? Because I haven't read the book yet. You
No, I have
emailed him.
not.
Said make sure to rub salt in the wound. No, I got to get that book. I really do. It's
I'll send you a copy, Dan.
This has been such a great time. Thank you again for coming on, Kyrill, and thank you for putting together Centerfin. Been checking it out. Really great stuff over there. And folks, thank you for sticking around to the end of the episode. We unfortunately, we always got to close up shop eventually, but we will be coming back at you soon with another exciting episode. And until then, happy trades.
Goodbye, everybody.
Two Bulls in a China Shop is an entertainment program, and all thoughts and opinions expressed in the show belong to the hosts and not of any company. They are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide entertainment about stocks and the financial industry of trading. If you make trades based on what you hear in this show, you assume all risks for those trades.